And briefly, solvency management is basically, most of the lenders are just grossly upside down. The lenders would probably be all out of business had the government not stepped in and bailed them out with $800 billion or so in bailout money. And the government also relaxed the mark-to-market standards. In other words, if a lender has, let's say, a $50 billion portfolio of loans, if mark-to-market was still in place, the government could step in and say, look guys, if you had to sell this portfolio of loans, what's it worth? And some other bank could take a look at it and say, well, gee, I'd give you $30 billion for this $50 billion portfolio. Well, all of a sudden the bank has zero equity if they actually took that loss. So to prevent that from happening, the government basically relaxed the mark-to-market standards and said, well, we'll let you value these portfolios just based on the cash flow. I would argue that's somewhat improper, but regardless, it saved the big lenders for now. My point in solvency management is the lender, no matter what resolution happens, whether it's a short sale, whether it's a deed in lieu, whether it's a loan modification or foreclosure, at a certain point in time, the lender takes that paper loss and turns it into an actual loss. The lender can't take those all at the same time. So they have to provide those and space those out over time. You may have heard some of your clients say, well, I applied for a loan mod and they lost my paperwork 6 times. That is effectively where the lender says, gee, I've done all the loan mods I can do this accounting period, this month, this quarter, and I can't do any more. I can't take any more losses in this particular area. So tell the people we've lost your paperwork, essentially reapply for that loan mod next month, next quarter, next year. That's the solvency management aspect of the balance sheet portion of the lender's decision-making model.